Hi there, and welcome to the Stockscores Market Minutes for February 21st, 2012. For those of you who do not already subscribe to the free weekly Stockscores newsletter, you can do so at the address on screen, stockscores.com/newsletters.asp. All right, let's get into the analysis. This week's topic is don't argue with the market. You know, when I listen to the financial news, I hear over and over again all this pessimism about Greece and about problems in Europe and about the economy and all that sort of thing. And it would be very easy, based on those headlines, to follow in that pessimism. Something to keep in mind, however, is that the market moves on what it expects to happen, not on what has happened or even what is happening. The market is always looking forward. In terms of the economy, the market tends to look forward 6 months. So following headlines leads to a problem for investors because headlines are based on what has happened. It is better to trust the market and do what the market tells you to, because if you wait for the news to come out, you will be too late. Now, in this realm of pessimism that we've had over the past, well, it's been going on for a long time, but really the pessimism about Greece has been going on for well over a month, and yet when you look at a chart of the S&P 500 over the last month, you can see a nice linear upward trend. Now, this particular chart shows 30-minute bars going back the last month, and you can see we are meandering in this upward trend. There's really no reason to be anything but bullish when you look at a chart like this, and so keep that in mind when you're hearing this pessimistic news come out from the media. Ultimately, you should look at the news in the context of market performance. When you have a market that is going up in an atmosphere of a lot of doubt, it really should mean that higher prices are ahead, because there's going to be so many people who doubt the rally that will eventually have to come in to the rally. And that's when we tend to see trend lines go parabolic. All right, let's get into the analysis. Here's the chart of the S&P 500, and you can see on the daily chart we've had a nice little rally. We are now at the highs of May 2011. And it's likely that we'll stall here. We can see that the market is a little bit indecisive at these levels. Volume is relatively light. However, the upward trend remains in place, and although I expect that the S&P 500 will probably get stuck in the short term, I think the longer term outlook remains positive. The Toronto Stock Exchange has not kept up with the U.S. stock market. However, it is in an optimistic pattern and is testing resistance right now. The market tried to break through resistance, kind of failed on that. But when you see the charts of commodities, which I'll show you in a moment, you'll see that there's a lot of reason why the Canadian market could break higher from here. The U.S. dollar is important for the Canadian market. It is obviously sensitive to what goes on in the world and what goes on with U.S. monetary policy. In the short term, we have falling tops. I've shown that with the red lines falling from January to February. The longer term, we have optimism. We have rising bottoms going back to the bottom in October of last year to the bottom in February. So we've got a little bit of conflict here. I think that the U.S. dollar is probably slightly more likely to go lower. We are seeing signs that the U.S. economy is improving, and that's positive for the U.S. dollar. But of course, we also know that the U.S. is printing money, and that is certainly bad for the U.S. dollar, and that could hurt whether this market for the dollar does in fact recover. So I'm sort of neutral on this right now. The chart of fear, which is the VIX, symbol VXX as an ETF, is in a downward trend. It kind of ran away from the downward trend line in the longer term, and we've bounced back a little bit, but I don't think that we're going to see a whole lot of a rally in the VIX. It may come back in the very short term, come back up to that downward trend line, but longer term, the trend in fear is down, and that is good for investors. Gold made an important break to the upside today. That's a little flag pattern that built up over the month of February. And with news out of China today of some monetary easing there, gold was able to rally higher. And that's important because it looks to me like gold will now continue that run higher. And that is good for the commodity-based economies like Canada and Australia. Chart for oil did also break higher. And again, when you've got problems in Iran plus efforts by the Chinese to improve their economy, that's going to be solid for gold. For oil, and it looks to me like oil is headed higher in the near term. So I'm bullish of both gold and oil, neutral on U.S. stocks simply because they are at resistance and need to take a little bit of a breather, and bullish on the Canadian market because of that optimistic pattern and because commodities look strong. U.S. stocks are at resistance, but the Canadian markets have room to move with an improving commodity market. Well, that has been the Stockscores Market Minutes for February 21st. Have a great week in the market and trade well.